Jigar Mistry is with us, co-founder at Buoyant Capital. Jigar, good to have you with us here. Thanks very much for your time. I just want to start with whether you think new highs are coming. And by Diwali, by the way, there's a time limit to it. Or do you think there is and maybe even bigger gains? Nothing is changed per se, except, I mean, the markets, of course, at the end of the day, about perceptions and self-fulfilling prophecies, and sometimes about outright valuation gaps, which I don't think is the case now. But maybe the former too. What's your sense?
Hi, Prashant. Normally there is a gentler warming into the show. This time I'm just bringing it on. But yeah, very difficult to say. See, what has changed at the margin? I think two things. One, Fed essentially coming on and cutting. You have seen the rupee move very differently vis-a-vis the dollar index. Right? In the past 20 odd years, you have not really seen dollar depreciate as much as 10, 11%. And rupee depreciating against the dollar. So that's quite against the run of the play, so to speak. That happened because sort of India-specific RBI, NDF shorts that got built out. And rupee has depreciated almost from 83 to 89 levels now. And that seems to have done. So if you continue believing that dollar will depreciate over the few months to come, then the incremental emerging market flows, which has gone to China, Taiwan, and South Korea, can possibly come to India as well. You add that to the fact that your domestic flows continue to remain very strong, but despite that, we are only a little over 5% of household savings coming into equities. Now, most developed markets are upwards of 20%. US is, in fact, upwards of 40%. So if that is the trajectory we are going to follow, then possibly each Diwali we can talk about newer highs coming through.
All right. Hi, Jigar. Good to have you on the show. Jigar, cash is still at around 13.5%. You're not as convinced as my co-anchor Prashant with his interactions with all the top fund managers that the new highs are around the corner. Will you be looking to deploy that money?
Yes, Nigel. So for us, the cash is also a proportion of sort of the flows that come in. It's a bit technical, but we don't run a model portfolio. And therefore, you will have sort of median accounts at a certain cash level and the fund account at a certain other cash level. And when flows are slightly high, then those two numbers can be a little different. So cash as an asset class is something that we don't believe in, but that essentially runs down to 5-6% on a normal basis. But see, it is an interesting space because earnings per se, on the first quarter numbers, we are tracking like 6-7% growth. Now, this is a time when the base was a lot better, right? April, May, June last year were peak election season. And if on that base we are growing at 7%, arguably in the festival season, the base normalizes. And this quarter will have at least a month lost or month pushed back because of GST announcement versus implementation. So we'll have to wait till January results to see how corporate India is reacting to the pivotal shifts of the government. Right, 4.5 to 5 lakh crores, that's almost 1.3% of GDP being pushed into the hands of people should have a meaningful impact. But countries that have tried doing that before have seen some amount of lag between sort of announcement and implementation. And everyone is keen to see how that plays out in corporate India. So unless flows change, and I would argue, in fact, the other way around, that had the flows not been this strong, you would have seen markets arguably at a slightly lower level than what they are right now. So yes, waiting for chances to deploy and bring it to a slightly normalized level, but it's not as high as the headline numbers do suggest, Nigel.
All right, what about FMCG? You're at around 4.5%. That's been a relative underperformer in comparison to an underperforming market as well. Growth has not been coming about, but now everyone's talking about this big consumption boost. You have the tax rate cuts, more money in the hands of the consumer. You have, RBI rate cuts as well, and now GST 2.0. Will you be looking at upping the ante out there?
So almost entirely all of this was built over the past 3 months, Nigel, for us, because since budget, when we sort of came through, we argued that there is a pivotal shift that's happening away from capex, both at the state center level and into consumption. So we're building that out as sort of things picked up, right? So GST 1.5 to 2 lakh crore is sort of the final cadence to the entire sort of song. The song started with states actually announcing very large freebies. And at one point, if you took all the announcements, and we did for the 16 states that went into elections, the announced freebie bill was higher than the capex bill. What they've provided for, thankfully, is only half of what they have announced, but that has still meant that the state capex has grown at a negative 4% level. Center initially, forego about 1 lakh crores in taxes, and now 1.5 to 2 lakh crores in GST. So all of this, when handed to consumer, and there are different housing, right? Like what the states have foregone versus what the center will give out are two different income housing categories. And to that end, it will impact things differently. Our base case still is that it impacts discretionary consumption a lot more than staples. I don't think people will go out and buy more oil or soaps, but consumption can play out. Like the last time I was on the show, we did discuss cement as being one of those. Secondly, automobiles can be interesting. The third part is sort of, a lot of these exhibition houses can be interesting. So we need to sort of see how this plays out. And therefore, we were keen to get a clearer picture from the quarterly numbers rather than high frequency data, because high frequency data tends to be a little more anecdotal, doesn't give you a really good picture about where the transition is at what stage.
What about autos? You said it looks interesting. The GST rate rationalization is a big tailwind, yet you're underweight. Your exposure is just 1.2%. The expectation is that it's going to be a good festive season. Companies have passed on the benefit with rate cuts. So what makes you cautious?
No, Rima. So this weight was close to 0% until a few months ago, right? So the way we run this fund is not really benchmark hugged in any way, shape or form. So if things look interesting to us at the margin, then that's where weights go to. Historically, we did mention that the way we have played this has been auto ancillaries, because most of those businesses were fairly expensive. And what GST cuts do is end up sort of, incentivizing production. And incentivizing sales rather than growing margins in a material fashion. So at the margin, I think things are looking reasonably decent. There are still pockets, I would say, of embedded value, right? Because the PE and VC firms have still sort of sprayed and prayed for the EV ecosystem to play out. I don't think there is a huge play in any of those companies where the embedded value is a large part of your total market valuation. But at the margin, I think some things are getting a little more interesting.
Jigar, hi, good afternoon. Good listening into you so far. I'm just wondering if you're willing to buy platform companies, including the new listing at 100 PE. What thoughts on consumer tech, internet, whatever you call it, this class of companies?
Right, Surbhi. So they say, right, PE is a state of mind. So,
Is it?
It can be. So, no, frankly, it's not something that... one thing sort of it does matter is that whenever you are discounting a lot of these businesses, the terminal value matters a lot. So it's not as much as the business that is changing today, as much as it's the belief that the terminal sort of US rates might still end up looking way lower. And given that India is now, 100 basis, so prior to the cuts yesterday, the policy differential was only 100 basis points. So repo and the Fed fund targeted at the upper bound. That I think gives room to RBI to cut as well. And when you discount this high duration cash flow streams, right, even by a very small margin, then the valuation looks way higher. So I think today most of these businesses are sort of responding to how the interest rate movement is rather than really a business change per se.
Jigar, very, very quickly, I know you have a theory on why the dollar has fallen, but why is the rupee fallen against the dollar and how that connects to foreign flows? If you can run us through that.
Hey, Prashant. So see, sort of what happens is that between 22 and 25, you had rupee relatively stable. And you had a situation where, the RBI may have thought that the FI flows, which started in September, could be contained at a narrower gap. So the shorts in the NDFs, the non-deliverable futures market, increased to between 80 and $100 billion. And they had to sterilize all of that through domestic liquidity crunch. So the LAF window went almost a 3 lakh crore negative number. And I think that sort of has been caught out in a meaningful manner. Then US sort of situation came in and FDI continued to remain very bad. So net, I think the 1.5% depreciation we saw played out over the course of the past few months for 3 years compounded. And I think rupee may have sort of hit its high or depreciated the most it would in the next sort of few months. So things should start looking better from here. And, we have put out a fact sheet which said that every time dollar has appreciated, developed markets do well. And when it depreciates, emerging markets do well for the past 35 years. That has happened, except it hadn't come to India, which I think could change over the next few months.
Okay. All right. So worse is the rupee depreciation in that sense behind, and lesser depreciation from here on. Jigar, thank you very much. Good conversation as always, and look forward to speaking with you on our next interaction. 90 points, by the way. Actually,